Welcome back, friends, to the class number 70. Now we are starting the new series. We are starting to learn about the different working capital products, which is practically done by the working capital department or business banking department of the lenders of the banks. So, when first in this video, we will try to classify the working capital products as per some features that they hold. So there are some features in the working capital products, like they can be fund based or non-fund based. They can be revolving, non-revolving. They can be for working capital purpose and non-working capital purpose also. They can be for short-term purpose and long-term purpose also. These are the kind of some features that are associated with these products. Working capital loan products doesn't essentially means that they are only for working capital purpose only. I am talking about the products which is done by the working capital department, that is the business banking department. So when we say the product, the loan type or the loan classification is that it is a fund based product. The fund based product, loan product, means the actual cash gets into your hand. You get to use the actual cash or actual money for your business. The loan types in which the actual cash is given to you for usage are called the fund based products. Non-fund based products are those in which there is no cash given to you, like bank guarantee. In the bank guarantee product, only a piece of paper is handed over to you. There is no flow of actual cash or money into your account, right? Now, it is important to understand what is revolving and non-revolving working capital loan products. When we say, first we understand the non-revolving. When we say non-revolving, it means once you have used the loan, then you cannot use that again. For example, let us take an example of a machinery term loan. Suppose you have been allowed a machinery term loan of rupees 10 lakhs. So you are eligible to purchase machinery using that loan worth rupees 10 lakh, right? So suppose you have bought the machinery and you have paid rupees 10 lakhs using this loan, right? Now the EMI starts. You start paying EMI of the loan. After 2 years, suppose you have paid back 5 lakh rupees. Now the balance outstanding of this loan is rupees 5 lakh. This is the balance principal outstanding. So can you use 5 lakh rupees again? Can you say to the bank that I have been sanctioned 10 lakh rupees and now my balance left is 5 lakh rupees? Allow me 5 lakh rupees more to draw down from here. Can you ask bank to give you 5 lakh rupees more? No, you cannot say that, because this is a non-revolving type of facility. Once a loan is given, once you have utilized the loan, you have to pay it back at a later stage, but you cannot use that again. If you want to use that again, then you have to get fresh sanction of that loan from the bank, right? So this is called non-revolving. While in case of revolving limits, the scenario is totally reversed. You have used a facility, you have paid it back, then you can use it again. You need not to get that facility re-sanctioned again from the bank. For example, letter of credit. Suppose you have given a letter of credit facility of rupees 1 crore. You have used 50 lakhs letter of credit, right? You have paid it back 50 lakh. You have paid back the 50 lakh rupees after 3 months, suppose, right? So now you are eligible to avail full 1 crore rupees again. You need not to get that re-sanctioned from the bank. Similarly, in cash credit limit, similarly in the overdraft limit. Don't worry, we will discuss each and every product in full detail in separate videos itself. I am just trying to explain the concepts to you. I am just trying to explain the features to you. So this is called revolving and non-revolving. Then we can say the loan products can be for working capital purpose and non-working capital purpose also. When you get the cash credit limit, letter of credit limit, overdraft limit, WCDL limit, packing credit limit, these facilities are given to you to manage the working capital requirements of your business, right? While when you get the building term loan, machinery term loan, right, these types of loans are given to you to manage your capital expenditures. Building, by using building term loan, you construct the building. By using machinery term loan, you buy the machinery, which is reported as fixed asset in your balance sheet, which is your capital expenditure. So then these are type of loans which are given for capex purpose. So then one another variety is derivatives. Suppose you have you are dealing in some foreign currency, you are importing or exporting the products, right? So you need to book the forex, you need to hedge your foreign currency risk by doing a forward cover transaction. So these forward cover transactions or currency swaps or interest rate swaps, these are all type of derivative products which also comes under working capital department. Then the loans can be for short term and long term purpose. By short term, we mean that loans can be repayable on demand, or the maximum time allowed for settlement of these loans can be 12 months. Right? The long term loans are those which need to be paid back after 12 months period. So the short term loans shall be reported as your current liabilities in the balance sheet, while the long term loans shall come as long term secured loans in your balance sheet as non current liabilities. Right? So these are the key features when we study about the working capital products. Now let us try to classify some of the products as per these features. So cash credit facility. So this cash credit facility is fund based facility, number one. It is revolving facility. It is given for working capital purpose, and it is given for short term purpose only. So these are the features, critical features in the cash credit facility. Again, I am repeating that we will be covering all of these facilities in full detail, and we will learn all about their operations, their processes in full detail in separate videos. Overdraft limit is treated same in line with cash credit facility in terms of these features. Although there is difference between these two facilities, but when we talk about features of fund-based, revolving, working capital and short term, they both are same. Similarly, working capital demand loans, WCDLs, are treated as in the same way. Similarly, your pre-shipment packing credit is having all these four features that we have discussed here. Then your post-shipment packing credits is also same, right? Now let us talk about letter of credit. Letter of credit, friends, is a non-fund based facility, right? The rest of the features are same. It is a revolving facility, it is given for working capital purpose, and it is a short-term facility. I am talking about normal letter of credit. I am not talking about Capex letter of credit facility here, right? So normal letter of credit facility is non-fund based. Rest of the features are same as like in CC limit. Although their purposes are different, we will learn about it in the coming videos. Buyer's credit facility. When we will cover the buyer's credit facility, we will try to cover why there is confusion here, whether to treat this facility as fund based or non-fund based. There is debate, regular debate on what to treat, on how to treat this facility. Practically speaking, this facility is a type of non-fund based facility, but some banks treats this facility at par with fund based facility also. The rest of the features are same like CC and OD. Capex LC. So word Capex means capital expenditure, LC means letter of credit. So this is a type of letter of credit which is given for your capital expenditure purpose. So this is a non-fund based facility, number one, and it is a non-revolving type of facility. Once you used it, you cannot use that again. It is given for non-working capital purpose because you are buying some machinery. So it is usually given for your capital expenditure, which is covering mostly machineries. And it can be for short-term and long-term purpose also. Capex LC can be for 6 months, can be for 12 months, and can go up to 3 years also. Can be short-term and long-term also. Now coming to bank guarantee. It is non-fund based facility. It is a revolving facility. It is given for working capital purpose, and it can be short-term as long-term as well, short-term and long-term as well, like Capex LC. It can be for 1 year, 2 years, 3 years, going up to 10 years also. Then machinery term loan, as you are already aware, this is a fund-based facility. You are given funds. Non-revolving facility, I have already explained. Non-working capital, because it is a machinery, and it is given for long-term purpose, 5 years, 7 years, 10 years, as the case may be. Similarly, your building term loan. And then there is another product which is called working capital term loan, which is not for Capex purpose. It is fund-based facility, non-revolving. Just the difference is it is given for your working capital purpose, and it is also long term, usually 3 to 5 years tenure. Then we talk about your supply chain finance like bill discounting, factoring, reverse factoring, channel finances. All these facilities are fund based. These are revolving, working capital purpose, and short term facilities like CC and OD. Then we come across forward contracts, currency swaps, interest rate swaps. All these products are kind of non fund based products, no funds given to you. They are revolving in nature and they are derivative transactions, right? They are not working capital or capex loans. They are derivative, and they can be for short term and long term purpose. They can be, you can book your forward for 6 months, 1 year, 2 years, 3 years. So it can be for short term and long term both, right? So these are the key features that I have tried to assign to a different types of working capital facilities. I hope you have enjoyed this. In the next video, we will understand the concept of main limits and sublimits. Thank you very much.